The Go Idaho Podcast is hosted by Greg Langhaim and Ken Lee. In this podcast, we feature everything Idaho, including some of the most influential people in this great state. Now here's your host, Greg Langhaim.
All right, welcome to the Go Idaho Podcast. Today's guest is Ron Hatch. Ron is a financial advisor here in the Boise area with Madison Pool. Ron was born in Canada. Interesting. Moved to Idaho in 1985 and has been here ever since. He has his Series 6, 63, and 65 securities license, graduated from BYU in economics, right?
Correct.
And then received his MBA here from Boise State. He is very involved in the community. He's volunteered for various businesses, political organizations, and is knocking on the door of retirement himself. So I'm interested to talk to him about his retirement future and what he's done over the years to kind of prepare himself for that. And yeah, I welcome, Ron.
Thanks. Glad to be here.
So do you consider yourself a cougar or a Bronco? BYU, Bronco?
I wear both hats, but
okay.
But the cougar blood runs deep.
All right.
It's tough when they play each other now because it's like every play you could be happy or you could be sad. So.
I get it. Before we jump into the financial stuff, by the way, you said he's something licensed or whatever.
Series 6 license.
That
right?
I don't even know what that means. Can
6, 63, and 65 are licenses that allow you to sell various financial products.
Okay.
And
okay.
Yeah.
All right.
It's a pretty hard. I don't think you'd pass the test. I wouldn't pass the
I
test.
wouldn't pass the test.
No, we both would be.
Well,
we'd be copying off each other, but then we'd both get the same.
That's why I'm a YouTuber. Yeah, we'd be copying off each other. What would you get? What'd you get for that one? No. Yeah.
Yeah.
I would
C,
just circle C. Anyway, needless to say, you're a lot smarter than we are. Okay. Before we jump into all that stuff, though.
Yeah.
We're gonna do a little icebreaker,
I love
fun
it.
stuff. We got to do some fun stuff here. Okay. So we like to just let the guest let their hair down, so to speak.
might be tough.
I get it. I'm bald too. Okay. All right. Favorite movie?
Yeah, we like the Lord of the Rings a lot. Those.
Okay.
Yeah.
All right. Favorite food?
Ice cream.
The sweets person.
Yep.
All right. Favorite Idaho destination?
We spent a lot of time at Lucky Peak over the years, water skiing. So it's close by, but there's some beautiful places in Idaho. I love to go on road trips and take a windy road and take some pictures of the scenery. Yeah, it's beautiful.
Yeah, it is. It's an amazing state. Do you have a favorite book?
There's a book by C.S. Lewis called The Great Divorce. It has nothing to do with marriage.
Oh.
It's a small book, but it's a book about the separation between heaven and hell.
Oh.
And it's fascinating.
Interesting.
I really like that little book.
I like it. Favorite holiday?
Well, for Thanksgiving, the last few years, our family, our children have all moved away, so it's just been Lisa and I. And so we've been going on trips. And so that's been fun. Sometimes to where the kids are and sometimes not. Sometimes we meet up with the kids in a different location.
That's cool.
It's been fun. Yeah, we've done some road trips and some of our children have come and met with us and we get together for a Thanksgiving dinner. And
nice.
I love that.
I know.
It does. I want to travel. I want to go, I love destination holidays. Have you ever done a destination holiday?
No, not yet. I think our kids have been too small.
Oh, okay.
To make it
you got to try
fun.
it one time. It's like you go somewhere that like say you're a Christmas person, right? And you find a town, like for example, I think McCall does like a big winter festival. Like if you would go up there, we didn't go up there, but I'm just saying like you could do something like that, right? Like a destination holiday, Yeah. So anyway, that's all I got. Now let's get into the
meat and potatoes.
Yeah, the nitty gritty.
The nitty gritty. Like, how do we save our money?
Yeah, exactly.
Ron, there is so much going on right now in our economy. The Fed's raising interest rates and people's 401k, had a real healthy bounce, and now they're looking at their numbers and they're just like, oh my gosh, what is happening? So I want to get into that. But I think our audience needs to learn just a little bit more of how you kind of got into the financial world, because you were a CFO of a roofing company, right? Or you did roofing.
Yeah. We had a family business, roofing contractors for many years here in the Valley. And about 2000, just after 9/11, kind of the perfect storm came. And so shortly after that, that business was shut down. So then I went on to work for a general contractor doing the financials, and did that for about 10 years. And then came over to do the personal side of the financial world. And so about just a little over 10 years ago, I got into this business.
Okay.
Yeah.
So roofing, to then that ended, and then you went to work as a general work for a contractor doing their books or their financial planning.
Yeah.
And then thought, man, you know what? I'd like to really change people's lives here in Idaho, and let's get into the individual return, or not returns, but individual planning.
Yeah.
Okay. Yeah. Well, here in Idaho, people have a huge following. I think people work hard, and they earn their money. I would think, after hard sweat. Was it hard sweat and
blood?
Sweat and blood.
Sweat
Yeah,
and blood.
hard
tears.
Hard sweat and blood. And tears, or all
sweat
of
and
that.
Tears. Sweat. Yeah. Sorry.
And one of the I guess, what's a general misnomer that people have about financial advisors? Because I think just in talking amongst people, the general consensus is, oh, they just are going to sell me whatever they make the highest commission on. Is that false, or are there people out there who actually do that?
There may be, but generally that's not the case. A lot of people think that they don't need one because they don't have enough money, which I also think is not correct. Because if you want to plan and improve your situation, you can find an advisor that will work with you. It doesn't really matter the size of your account. It's kind of what you want to happen, and if you want to get out of where you are financially. And I think most financial advisors out there are looking out for the best interest of their clients, and that's why they're in the business.
Hey, if you're enjoying this clip and you want to listen to the full episode, go to wherever you get your podcasts and subscribe to the Go Idaho Podcast. Now, back to the show.
You said no matter what your situation is and how much you have or where you are, right? So somebody who's like super young, maybe just graduated college or is in college, and they've got $100 to invest, should they start investing or doing something with that money?
Well, the earlier you can start investing, the better off you'll be, because that money will have more time to compound over the years. But having a plan, so if, at first it may be they're just saving in the bank so that they have some emergency funds. If they keep saving over time, then they'll find that they're able to stay out of debt easier because they've got money for those things that happen, and life always happens. It's not a straight ride up. It's a bumpy ride. And so starting as early as you can, being disciplined is a great start. But you can take young people that, even if they can't implement everything today, they can get some ideas as to what they want to do when they can. And so they may, when they're young, they may need some life insurance because they've got a young family. And if something happens to those that are earning the income, that is a much bigger hit than if they have $3,000 or $4,000. If they lose their ability to earn an income, that's devastating financially. And so then you have to make decisions that you wouldn't want to, but you have to. So all the different aspects, it's not just the investment accounts, it's insurance and those kinds of things as well that fit into a financial plan for someone.
For somebody who's young, do you think there's a generational thing where I feel like there's a lot of young people now that like life insurance. Well, I don't need life insurance. Like, what is that? Like, where my parents, like that generation, everybody had life insurance. I think there was, I don't want to say more responsible, but I think there was just, they understood it, where I feel like the newer generation just doesn't get it, and they're like, I don't need that.
I'm not sure that I've experienced that in large numbers. I'm sure there are some. I think in general, many people are underinsured.
Okay, so let's talk about that, because we've met several times, in your office and looking at my my plan, I guess. But how do you know how much insurance does someone need? I mean,
so right? It's interesting. The insurance companies will not overinsure a person. Okay. So if you went to the insurance company and said, I want $20 million of life insurance, they would say, okay, what's your income?
Yeah.
And depending on your age, so for instance, if you're 25 years old, they would say, okay, well, you've got 40 years till you're going to retire. So what's your annual income? Multiply it by 40. Okay, that's how much insurance we would gladly sell to you because you're worth it. That's how much income you'll lose if you die. You may or may not be able to afford that amount, but they would do it.
Okay.
Generally, if you pass the health exam, they'd be willing to do it if you can afford it. So, it's like your house. You can't really over-insure your house. They won't let you do that. If it burns down, they're not going to give you twice what it's worth.
Right.
And so life insurance is the same way. They won't sell you more than you're justified in getting. But they do, your economic life value, how much money you'll make over your lifetime.
So I've seen they have like, I know you probably do this, but they do like a financial needs kind of analysis type of situation where they'll like put something together and be like, okay, what's your income? How much money would your spouse need if you passed away? Do you want to pay off your mortgage? Like those types of things, right? That they kind of put into that scenario.
Sure. Yep. Yeah, they do that. And then another way is, okay, well, how much income or do you need to live on? And so if you took the amount of life insurance death benefit that you received, and let's just say you're in a situation where you have many years left to the surviving spouse of the family has many years left to live, including through retirement. So you wouldn't want to spend the principal down to nothing because then there would be nothing for retirement.
Yeah. So
then you say, well, how much can we live off the interest? Well, now you're starting to get into where you need a pretty large number to do that for 50 years, to live off the interest for 50 years. So that's another way to kind of factor in how much do you need? And then you may get to the point where, well, I can't afford what I think I need. So let's get the most that I can afford reasonably under the circumstances. And so that way you can plan for a worst case scenario so that if something bad were to happen, a death of a loved one, that you don't have to make certain decisions. You may choose to stay in your house. You may choose to stay in your city. If you choose something else, it's because you've decided that's what you want to do, but you don't have to because you have some financial resources.
Got it. Now, one of the things that I was, there's a personality on radio, Uncle Dave Ramsey, who is adamant that whole life insurance is absolutely the worst thing you can buy. You should always go term. But you have a different spin on that. And when you showed it to me, I was like, okay, I think I can wrap my head around this. This makes sense. So what is the whole negative concept, or why do people think whole life insurance is just the worst?
So term life, first off, is a great financial product. Most young people that need a large amount of coverage, let's say they needed $1 million of coverage or more, can only afford at that stage of their life the premiums on a term policy. And so if they need a lot of coverage, they're going to need some term. However, having some permanent insurance is important because we are going to die.
Right.
So term insurance only pays out if you die young or younger than you expect. So if you buy a term policy that has a 20-year fixed premium, if you don't die in 20 years, you get nothing back. And then after that period of time, if you want more insurance, you have to go reapply and go through underwriting. And if you can get through underwriting, great. But if you can't and you're uninsurable, then you have no insurance. Whereas if you bought some permanent insurance, maybe a smaller amount, along with your term policy when you were younger, that permanent insurance never goes up in price and can never be taken away from you as long as you pay the premium. So it is a permanent solution to a permanent problem. You are going to die, and your family will get some money when you die from a whole life policy. Hopefully, your family won't get any money from your term policy because you're going to outlive it, which is what you want.
Right.
Well, what about the thought process of, I'm just playing devil's advocate here. Well, instead of spending that money on the permanent insurance, you invest that money. And now you're getting the compound interest. Now you're growing it. Now you're doing all those things, right?
Sure. And I had a lot of questions about that myself. But it turns out that most people don't do that.
That's true. That's true. No, it's the truth.
Yeah.
Secondly, what you want to avoid down the road is having all of your money act the same way at the same time. So if all of your money is in the investment world, great. It's going to trend upward over time. You're going to earn money on that, and over time you're going to make money. But when you are living in a time period like right now, and you're retired and you need to spend that money, it's a terrible time to pull money out of your investment account because the markets have already dropped. And so now you're pulling money out at a loss, and it's kind of like poking a hole in the bottom of the bucket. It's hard to keep that bucket full of water, and it's hard to keep your money as long as you might live when you're having to spend it at a loss. So cash value inside of a permanent life insurance policy can be used in two ways, but one is as a buffer. And so if you have sufficient cash in your permanent life insurance policy, you can borrow against that. It doesn't go down in value. It doesn't drop when the market drops. It has guarantees in it, and it does earn, not as much maybe as you might earn in the market, but it never goes down in value. So you could use that as a buffer on down years like we're in right now. So if you're in retirement and your market account, your investment account's down 20%, you could go over to your life insurance policy and take some cash out of that. And if you've done it right, you can spend that money without any taxes on that life insurance cash value, which means you have to take out less from your life insurance than you do from your investment account. Because your investment account, well, let's assume it's IRA, 401k money, then you would have to pay tax when you pull that out. And so you don't need as much out of the life insurance to live on because you don't have to pay any tax on it.
So diversity is really a big proponent of what you teach.
It's a strategy. There's a certain amount of life insurance that your family may need on your premature death, but the goal is to get you to the end of retirement. And if the life insurance policy can help you do that, either by providing the death benefit on your death to carry the spouse through to the last few years of life, or if you use it while you're alive and use that cash value to help your investment accounts last longer, either way, it did its job. And investment accounts are fantastic vehicles for accumulation, but they really weren't designed for the decumulation or the spending because sometimes markets are down and it's irregular. And when you're on kind of a fixed budget, when you're retired, you can't spend negative.
Right.
Yeah, you spend the same amount year after year, approximately. And so when markets are up, that's great, but when markets are down, that's not great. And so they weren't designed for that. Insurance products were designed for the income phase or the decumulation or the distribution phase. Maybe they don't accumulate as fast, but they have guarantees in place, and they work very well in the distribution phase. So it's kind of putting the two together is what makes it powerful.
So right now, people who you work with, who you set them up on that diversity plan where you have the whole life, are you having clients right now who are calling you and saying, hey, Ron, listen, I know we have this investment account, but I'd like to draw off my whole life because the market's in the tank right now? Or
Well, yeah, we had some clients call the other day, and they needed $20,000. Of course, their investment accounts are down. I mean, I wish I could say that none of my accounts were down, but they are. We've had them invested in what they felt was appropriate amounts of risk, and those risks this year haven't paid off. So their investment account was down. They have another policy. It's not a life insurance policy, but it's a guaranteed product, and they were able to take the $20,000 that they needed out of that product, which did not go down in value. And so they got the money that they needed, and that was important to them, not to spend at a loss.
Yeah.
Other than and give their investment account time to recover.
that's huge, especially in times like this. Now, Ken and I, we mentioned that we would not pass the Series 6 licensing portion, copying off each other. So help me understand this for someone like me who might be listening, or someone like Ken might be listening. You have your employer who's matching your contribution, let's say. Do you recommend maxing that out, or just a portion of that and then investing in some whole life, or max with whatever your employer will match and then take whatever you have left over and invest it? Like, what's a good strategy for someone?
So it might depend somewhat on the tax bracket that the person's in.
Okay.
But I do recommend getting the free money from the employer, putting enough in to get the match.
Yep.
And then if you have additional funds available above that, then you could look elsewhere. You may still choose to put it into the 401k at work if you need the tax deduction. If you're in a fairly low tax deduction, you may look at something else like a Roth, where you don't get a tax deduction, but the money grows tax-free and spends tax-free. Or you may look at what we call a non-qualified investment account. It doesn't have any tax-favored status to it.
Okay.
It's just an individual or a joint investment account, which doesn't have any rules per se, like how much you can put in, how much you can take out, what age you have to be.
Okay.
It's just like a bank account as far as rules go.
Okay.
So you could put money into an after-tax investment account, and so that way you have different buckets with different tax features. It's nice to have a large 401k, but in retirement, all of that will be taxable income, which also affects how much of your Social Security will be taxable. By the way, Idaho doesn't have a income tax on Social Security income. You have to pay the federal tax, but there's no state income tax on Social Security.
Well, look at that. Idaho just got better, a little bit better.
Yeah.
Well, it's awesome. It's even better, is what I meant to say.
Yeah.
Even better. That didn't come out right, did it? Wow. Okay. Yeah.
So strategies based upon the tax situation.
Okay.
We all assume, I guess all is a big word, but many people assume that when they get to retirement, they'll be in a lower tax bracket. But that may not be the case. They may not be because they've become successful and their income is much higher, or the tax rates may have gone up. And so the idea that all the money should be pre-tax may not always fit with the circumstances of the individuals.
Interesting. Are you seeing that age for retirement go up? I mean, I know you've kind of filtered everything off of age 65. Is that right?
Well,
are people retiring later because of the cost of things?
I I don't know that I've seen that yet, because the cost of things, it's more of a recent phenomenon. People that can retire as early as they can, but obviously circumstances change, and people may have planned to retire early and then decide to work a few years longer. It is it's amazing how much it can help a retirement if you work a year or two longer.
Is that right?
Yeah, I mean, probably depending on where you work too, right? Or are you just talking about
cash in the account?
Cash in the account overall.
Well, one of the things about retirement is that these days we're living longer. And so a retirement might be 30 to 40 years.
Yeah.
Oh, I see.
So your money has to last a long time. Most people have not accumulated enough to just live off the earnings. So they're spending earnings as well as principal. But they don't want to run out of money before they run out of daylight. They want their money to outlast them. And so sometimes when you're getting close to that decision of when to retire, a year or two of working instead of spending can make a big difference on how long your money lasts and how much. It isn't necessarily how much you save in that last year, but how much you save by not withdrawing from your accounts.
In Idaho, there's a lot of self-employed people who have moved here either from the last few years and have started their businesses or have just ran successful businesses. You know, they don't have an employer to match their 401k. So how does a entrepreneur, a small business owner, self-employed actually start the process of, okay, I need to get something because this business is going to either wear me out or maybe I'll sell one day, but the likelihood, I don't know. So
there's several things that if a person can do if they're self-employed. Depends on the number of employees that they might have, but they can do a solo 401k if they want the tax deduction and save that way, of which they can contribute. And if they are making enough money, they can also do a corporate match. They can choose to do that. They can do profit sharing to get up to the maximum limits that are allowed. And so an individual can do a solo 401k plan, of which they can include their spouse. And I think it would be good for even if a self-employed person had a certain amount that he paid himself and then said, well, pretend I worked for someone else, and I would do some percentage of my salary to start setting it aside, because most self-employed people pour everything into the business, and it's all or nothing. If they can find a way to do it, it'd be good to start saving.
I think so.
Was there anything that like really stood out to you that made you say, man, this is why I want to be in, this is why I love being in this business, or this is why I love helping people find that financial freedom? And I know that probably wasn't even on the list of questions to ask you. I just thought of it, and I was like, there's got to be something out there.
Format?
We're just rolling. We're just rolling.
I guess I've always been. I've always tried to be a good saver myself, and without the training, I didn't necessarily know what to do with some of those savings, but I found that having cash available in some format was pretty powerful, and it not being burdened by consumer debt was very liberating, and so those concepts and ideas and sharing that with others has motivated me. Sometimes when you help a young family just get some life insurance coverage, when they've got 6 or 7 kids and no life insurance, and then you are able to help them do something, hey, that could potentially change their world. Hopefully everything goes good and they don't need to use it, but if they did, that it would really benefit them. Sometimes it's having someone come in that's just retired from a local company and they have a large 401k and they have no idea what to do now. And when they leave your office, they're just like, wow, we really appreciate, we know what we're going to do, and we have confidence that it'll work.
Mm-hmm.
And that's fun.
Yeah, I think there's a reward in the service industry where it's particularly a service industry where you're helping people. I think there's something to that, for not just you're excited for them, but there's also some reward that you get, and you're not doing it for the reward. You're doing it because you genuinely want to help people. And I think there's something to that, and just, I don't know, and just making life better for yourself, in a certain way, what I mean? Because there's a lot of people that can make a lot of money, but they're just making money. They're not helping anybody while they're doing it. They're not, servicing anybody while they're doing it. So, and I don't think when people think financial advisor, they think, oh, he's out there helping the people. You know what I mean?
Yeah.
I don't think that's the thought process on it. But when you say it the way you said it, you're setting people up for success in their lives and their future and stuff, and that's awesome.
Mm-hmm.
So I love it.
Yeah, absolutely. And I think too, with so many people coming out of they're in that, the baby boomer is retirement, is all happening, I think, right now or the last few years. Is that kind of what you're seeing?
Yes.
And so a lot of people are probably, just like you said, just have no idea now how much to pull out or what they can do. And meeting with you is probably, just like you said, just such a reward. Now, when people say, okay, Greg, I love it, I want to work with Ron, how much do you charge them up front? If they come and meet with you for an hour, how much do you ask them for? Do they pay you for that time, or how does it all work?
We will meet with someone, and there's no charge to do that. If we can teach them something, if we can show them a path forward, and they choose to work with us, then it's likely that we'll implement some changes to what they've been doing. We may move their money, we may put it in different places. If we do that, generally we get paid by the companies that we do business with.
Okay, so the individual's not having to pay you out of pocket for...
Correct.
Got it.
Correct.
Yeah, that's pretty interesting.
I love that.
That is cool.
The other way that we feel like we get paid is if those people tell their friends about us and recommend us, and then we have a chance on a positive basis to meet with someone else, and we kind of feel like that's a payday.
Yeah. So you're knocking on the door of retirement yourself, so you're advising people what to do, and then here you are, maybe a few years down the road, going to be punching the clock possibly for the last time. I don't know. So what are you seeing right now that you're like, oh my gosh, I need to kind of change my strategy on how I advise people based off of my personal experience coming up to retirement? Like, what changes are you seeing that you would have made?
Well, one of the things that I would have done younger was I would have implemented a whole life insurance policy.
Really?
Younger.
Really?
First of all, the premiums would have been...
I was going to say the rates were
expensive,
probably way less expensive.
and would have had more time to build that up, because I want a significant chunk of cash value inside that policy available to me to buffer my investment accounts in retirement. I know there are going to be other years like this year. And so, but I do have a whole life policy in place that is growing, and
you're practicing what you're preaching.
And
I love that.
I'm actually putting in extra money above the premium, which in some cases you're allowed to do.
Okay.
And to build up cash there. I also contribute to a 401k. I also have money in a Roth account. I have a non-qualified joint investment account that I fund. And I also have some fixed annuities, some guaranteed products that they're guaranteed not to go down in value, and they earn a little bit. And they have a little more. Well, they have some liquidity. You can get access to some of the money within a certain time frame, and then again all of it. There's other products. There's other products that I have in the portfolio. So not all my money is acting the same way at the same time. I have a lot of different choices. Some guaranteed, some not guaranteed. Some with much more risk than others. And I believe it's a plan that will work regardless of what happens in the economy. Mm-hmm. If everything's up, of course, it's a piece of cake. If things are down, it'll still work. Mm-hmm. And so... Yeah.
I love that. I love that because you're doing everything that you're counseling or advising your clients to do. What about, or what were you going to say?
There's one more thing that I would add, especially these days, and that is long-term care planning, of which I do have a long-term care plan in place.
What is that, and how does that work?
So it's another insurance policy in the event that my spouse or I would need long-term care, which means there's two activities of daily living that you can't do by yourself anymore. You can't dress and get to the bathroom and eat and different things. So that is a pretty expensive undertaking these days. And to do it with your own money means two things. It means you're spending a lot of your money to do that, and you're paying full price. Mm-hmm. So it can derail a family's financial plan because all of a sudden they have to come up with an additional $50,000, $60,000, $70,000, $80,000 a year over and above what they were planning on.
That's crazy.
That's exactly
and no
what
one
happened.
Thinks about that.
Yeah, it's exactly what happened to my grandma. And so after she passed, my dad did exactly what you're talking about. He's like, you know what? I'm not going to let that happen to my children. They're not going to have to pay it. So he looked into the long-term care stuff, and that's something he has now.
If you have very little in assets, if you don't have any money, you will likely qualify for Medicaid to cover the cost. However, the number of Medicaid beds is limited, and you may end up having to move cities to get a Medicaid bed.
Wow.
That is a possibility. So if you want some choices, if that were to ever happen, and I know people joke about it and they say that's never going to happen to me and I'm going to drive off the cliff myself and things like that. The facts are you usually don't get that opportunity. And so planning for it is a huge deal because it can wipe out your plan.
So what if that happens? What if someone drives up, they never use it? Is there a cash value to that since you never fell into that category that you can withdraw, or is it just kind of like term, like it didn't happen so you lost it?
Both types of plans are available.
Okay.
We prefer one that has the cash value feature to it. There is a pure insurance, and if you never use it, you lose it feature. One of the things that we don't like very much about those plans, at least many that we see, are that the premiums can increase. And so we have clients that over the years have received 4, 5, 6 price increases.
Oh, jeez.
Or instead of taking a price increase, they can decrease the benefit that's paid out. So they often choose to do that. We don't like that. So the policies that we use more often are policies that are guaranteed so that the price won't go up and that the benefit can't decrease. And also has a feature where somebody you care about would get some money if you never used it.
I see.
Yeah.
So could your dad can you transfer policies within, or can you buy policies for your kids? Or do you just have to be an adult to buy one? Does that make sense?
Could your a long-term care type of thing, you mean?
Yeah.
Oh, I have no idea. That would be interesting, though.
You could have, a particular one we use has 2 people on the policy, so it can have husband and wife.
Okay.
You could also have someone with insurable interest, so let's say a single a parent whose spouse has passed and a child, as long as they're getting into the nitty-gritties of it, but there are situations where you could have a child and a parent on the same policy.
I see.
But family members could help pay for one, certainly for a parent. Who pays the policy is one issue.
Okay, so for my 4 kids, let's say, I would have to buy 4 separate policies in their name, right? But could I be on the policy with them because they're minors, or?
Yeah, probably.
Or did they?
Yeah, normally on a long. I have to double check.
Are you talking about long-term
I
care?
guess. Why am I thinking
I don't
that?
think.
I don't.
People don't get long-term care for the kids.
But it's
for like when you're older.
But we have clients who have kids with disabilities that they need help, because the spouses are working.
Oh, I think that's a difference.
Is that completely separate?
So you may have a life insurance policy on your children,
yeah,
or you may have life insurance on you and your spouse to take care of a special needs child once you're gone.
Okay, I guess that's what I'm wondering.
Okay,
There's
separate.
Lots of situations along those lines.
I see.
Yeah.
Okay.
Generally, you'd be
35
35 and older before you start thinking about long-term care, and it's probably closer to 55 before you start. However, once you've been diagnosed with something, you may not be able to get it. So
is that right?
It's probably earlier.
Are the premiums less if the earlier you are in age?
Yes.
Okay.
Yes.
So it's kind of like the whole life.
Yeah. Money and getting yourself set up for retirement and I call it financial freedom. I think I think that's a term that I think people can get behind and understand. To have that financial freedom is, unless you're the expert, go talk to an expert.
Yeah.
Go talk to somebody like Ron, because you think you listen to these podcasts or you watch a YouTube video and you think you're an expert. Mm-hmm. You're not. I mean, it's just what it comes down to. You're not. And you might think, well, yeah, I'm just going to put my money in a Roth IRA and then this over here and I should be good.
Well, and how awesome to have Ron will just meet with you, and
yeah,
not
no cost.
Yeah, send you a bill.
No, that's really
that's
cool.
Huge.
That is cool. Fair enough. Can we go rapid fire fun now for a little bit?
Sure.
Can we do some fun stuff here? Let's jump into it. These are just going to be rapid fire, and I'm going to go through these are this or that questions. Okay, so it's literally you just pick one. It's super easy, super simple. So let's just start with the first one. Italian food or Chinese food?
Italian.
Yeah, everybody's picking Italian. What would you pick?
Chinese.
I don't think I've ever asked it.
I love Chinese.
Me too. I would go Chinese all
Chinese
day.
food.
But everybody else
Maybe
is going.
it's the MSG.
Chinese is good.
But
I don't know why I said Italian, but
most people go Italian though.
Yeah.
I mean, we haven't had one say Chinese yet. Okay. Mountains or the beach?
I know.
Mountains, I guess.
Yeah, that's a tough one. Burgers or tacos?
Burgers.
Summer or winter?
Summer.
Ketchup or ranch?
Ranch.
Do we need to add fry sauce since we're in Idaho?
Oh,
ketchup,
I
ranch,
didn't
or fry
think
sauce?
about that. Okay, ketchup, ranch, or fry sauce?
Fry sauce.
Okay. Yeah, there we go. Yeah. Air guitar or air drums?
Guitar.
Air guitar. All right. Are we like bass guitar, kind of cool vibe? Or are you like a like get after it kind of guitar, air guitar?
Oh, bass.
So he's the kind of just chill, kind of cool. I kind of get that vibe from you, like just staycation or vacation?
Vacation.
Coffee or tea?
Neither.
So what are you? Soda, or just water? Red Bull, like me.
Drink some soda, but not a ton.
Okay.
Milkshakes.
Yeah, milk, dude.
Oh,
Can you imagine rolling out of bed and just having a milkshake?
That's
Man,
almost what you did today. Is it at breakfast into Little McDonald's?
Yeah.
But you went just the sausage McMuffin.
Sausage McMuffin.
So with the egg or just straight sausage?
Just sausage.
Oh, okay.
Yeah.
All right. Watch sports or play sports?
Well, anymore it's watch.
How about when you were younger?
Played a lot.
Awesome. What sports did you play? Anything particular that
I
you
played
loved?
In high school. I played basketball, volleyball, and football.
Oh, a little 3-sport athlete.
Well, you were in Canada, so are those different? I'm just joking.
Wow. He just went right after your Canada blood right there. Well, it just a little softer.
A little softer.
It was two-hand touch football. It wasn't tackle. No, I'm just kidding. I'm kidding. Okay. A movie or a book?
Movie.
Love it. Is there anything else, Ron, that you're seeing that people should know about or be aware of? Someone listening to this, they're just like, gosh, I need to do something, or I need to watch out for this.
One thing that we're starting to work with our clients for this year's going to be a real puzzle to people because their investment accounts currently are down. But when they get to the end of the year, they're going to get a 1099 for dividend and interest income. And so they're going to owe taxes even though they lost money in their account.
Whoa. Wait, huh? Come back on that.
Good old government.
Yeah.
Yeah. So
wow.
Any interest or dividend income inside their portfolio, if it's not an IRA account, if it's an after-tax account, they will get a 1099 for that amount. And so for some people, that'll be a big chunk, and it'll come as a surprise. And so they may have unrealized losses inside their portfolios that if they plan right, they could exercise some of those, sell some things, experience the loss to offset the income. And then you have to wait a few days, a couple of months to rebuy. So you do have some risk there that prices could change on you, but before you rebuy the portfolio. But there's going to be some people that are going to come around next April and be surprised with a tax burden that they weren't expecting.
Gosh,
I didn't even think about that. You just think, oh, the market's down, I'm lost. Why would I get a 1099 for dividends? Yeah,
inside your mutual funds or inside your portfolio accounts, they're buying and selling and doing things. And they may have gains inside that, even though the prices have now dropped. And so your portfolio is down in value, but you get a taxable event inside the account. So pre-planning, talking about it. Then at least if they're aware of it, they may choose to do something about it. They may choose not to, but at least they're aware of it instead of being totally unaware.
Wow.
And again, this is why you have to have somebody like Ron.
Oh, totally.
Because I want to just be like, let's get rid of money. Let's just go back to the old barter system. Let's just,
I got commemorative coins.
Yeah, I caught some fish, and what do you have? Oh, I made some bread. Let's just trade, right? Like, oh my gosh, money is confusing.
It is. There's a lot to it. There's so much to it. How do people who are in, say, Idaho Falls, can they work with you, or do you only service people here locally in the Meridian, Boise area?
No, we work with people throughout the state and throughout the country. So,
okay.
Especially today with Zoom and other options to meet online. A lot of things, online, but we have clients all over the place.
That's great. So our Coeur d'Alene listeners, or our Idaho Falls listeners, all of them can contact them, or like you said, you even said out of state too. So
sure.
Pretty much anywhere. Okay. It's good to know.
That's great. Well, how do people get in touch with you? If they're like, man, you know what? I like what I'm hearing. I don't know where I'm at financially. Maybe sitting down with Ron will be like the first step, or calling Ron. How do they get in touch with you, and how do they find you?
Sure. My phone number, the office number is 208-898-7696. Email, website.
Awesome.
Yeah, we'll put all that. We'll link it all up.
And for sure. Yeah. If you're watching this on YouTube, we're going to put all that stuff down in the descriptions. And if you're listening on the podcast, we will also have some links down there as well in the description of the podcast. So make sure you guys go check that out.
Yeah, and if you're listening and you know of someone, give them Ron's info, and say, hey, I heard this podcast. Share the podcast, and encourage them to reach out to Ron and get a meeting set up just to see where they're at and how you can help them. Of course, you can't guarantee anything, but as far as returns, right? Or
no guarantee.
Yeah.
What he doesn't. You can't control what the government and how the world does. Come on. Hey, I wanted to say one thing before we signed off.
Yep.
So Ron brought in this big piece of paper here, guys. Look at this. This is if you're listening, you can't see it, but he's got like notes written down. I didn't see you look down there one time, and that just tells me he knows what he's doing. It's in his head. It's there. Yeah. Like he's like, I better have no. He didn't even need them. That just tells me he's an expert and knows what he's talking about. So anyway, I just noticed that throughout the whole thing. I was like, wow, okay then.
Yeah.
So anyway.
Well, no, Ron, thank you so much. I highly encourage reaching out to Ron. I personally have, and my experience with working with Ron was we just sat down and he kind of just flipped a pyramid upside down is what you did. And he said, let's start with your safety net at home. Like what can you and Sarah put away to make sure that the lights stay on, kids are fed. And then we just kind of worked up that tier to now we're doing some fun stuff, I think. And it wasn't just all of a sudden, it was just a gradual process, and now we're getting there. So I appreciated that, and I think anyone who goes in and meets with Ron will feel the same way. They'll come out feeling really appreciative, and like I said, he didn't ask for a check, but it's time is value, but he really pours value into you. So thanks so much, Ron, for coming on.
Thank you. It's been fun.